Stop buying the fake dip. Imagine this. The S&P 500 just dropped 2% in 2 hours. The Nasdaq is bleeding red, and all over Reddit and X you see the same thing. I'm buying the dip. Millions of retail investors trading from their 401ks, their Roth IRAs, their Robinhood accounts rush in. They feel smart. They feel brave. But here's the mystery no one is talking about. Every single time retail traders as a group buy the dip, something invisible happens. The dip keeps dipping. The bounce never comes. And by the time the market actually recovers, they've already sold in panic. Why? Are they unlucky? Or is there a hidden trap, psychological and structural, that guarantees they buy too early and sell too late? I'm going to show you exactly what's happening and give you 3 steps to buy the dip like an institution. Pain point: the mistake you've made. Let me describe a feeling. You've felt it before, maybe last year, maybe during the COVID crash in 2020, maybe during the inflation scare of 2022. The market drops, your portfolio drops with it. You feel a knot in your stomach. But then you remember the golden rule: buy the dip. So you open your brokerage app, you type in your favorite ticker, maybe NVDA, maybe SPY, and you hit buy. For 5 minutes, you feel like a genius. You bought on sale. Then the market drops another 1%, then another 2%. Your $100 share is now $92. Now you're not a genius. Now you're down 8%. Now the knot in your stomach is a fist. Here's the painful truth. Research consistently shows that retail dip buying trades underperform systematic investing schedules, and the gap is not small. Revelation: the counterintuitive science. Here's the revelation that flips everything. You assume buying when prices are down is smart. Long-term? Yes. But here's the counterintuitive part. The moment retail traders as a group decide to buy the dip is usually not the dip, it's the halfway point. Brokerages like Fidelity, Robinhood, and E-Trade publish anonymized data on when their users buy. The pattern is astonishingly consistent. When the S&P 500 drops 1%, retail buys a little. When it drops 2%, retail buys more. When it drops 3%, retail buys aggressively. But the actual bottom, the true turning point, usually happens after retail buying has already peaked. Retail buys too early. They exhaust their cash. Then institutions step in and buy the real bottom. March 2020. COVID crash. Retail dip buying exploded around March 12th and 13th during the initial sharp drop. The actual bottom? March 23rd, 11 days later. Retail held bags. Institutions bought the bottom. June 2022, inflation peak. The Nasdaq fell sharply over several days. Retail bought heavily early in the move. The market continued lower before finding its footing. Obstacle: what's actually stopping you? Now, you might think the obstacle is bad advice on social media or hedge funds manipulating prices. Those are factors, but they're not the main obstacle. Here's how it works. When the market is going up, you feel smart. You check your app 3 times a day. You tell yourself, I'm a long-term investor. Then the market drops. Suddenly, being long-term feels terrifying. Your brain whispers, what if this time is different? What if it drops another 20%? That voice is not greed. That voice is fear. And fear is what makes you buy the dip too early. Here's the math. You have $10,000 in cash. The S&P 500 drops 5%. You think, great, I'll buy now. You put in all $10,000. The market drops another 5%. You're now down 5% on your new purchase. You feel sick. You're out of cash. Then the market bottoms and rallies 15%. You make back your loss plus 10%. But if you had just waited just one more week, if you had bought at the real bottom, you would have made 20% instead of 10%. You left 10% on the table because you rushed. Over a 30-year career, that pattern costs you hundreds of thousands of dollars in your Roth IRA or 401k. The obstacle is not the dip. The obstacle is your urgency to act before the dip is finished. And here's the dirty secret. Institutions benefit when retail buys the dip early. Your early buying can provide liquidity for them to reduce positions into. Then the market drops further, and they buy back lower. That's not a conspiracy. That's just order flow dynamics. Fix. 3 actionable steps. Step 1. Stop watching percentage drops. Watch the VIX. The biggest mistake is treating every 3% drop the same. A 3% drop in a calm market is very different from a 3% drop in a volatile market. Here's what you do. Look at the VIX, the CBOE Volatility Index, the fear gauge. Normally, the VIX sits between 12 and 20. When the VIX spikes above 30, that's panic. Above 40, crisis. Your dip buying trigger should be a VIX condition, not a fixed percentage. For example, I will only deploy my first dip buying tranche when the VIX closes above 30 for 2 consecutive days. On Robinhood, tap Markets, Indices, VIX. On Fidelity or Schwab, search for VIX or dollar VIX. Volatility is your signal. Price is noise. Step 2. Use time-based tranches, not emotion-based lump sums. This is the single most powerful psychological tool you have, and almost no retail investors use it. Instead of saying, "I'm buying the dip today," say, "I am deploying my dip cash over the next 10 trading days in equal amounts." Example, you have $5,000 for dip buying. The market drops 4%. Instead of buying all $5,000 at 9:31 a.m., you set a calendar alert. Every day for 10 trading days, you buy $500. No emotion, no checking the chart, no Reddit. Why? 2 reasons. First, it protects you from buying the fake bottom. If the market drops another 3% after day 1, you're still buying lower on days 2, 3, and 4. You dollar cost average into the dip. Second, it removes the psychological terror of timing it perfectly. You become a machine. Machines don't panic. One more thing. If you're trading in a taxable account, remember the wash sale rule. Buying the same security within 30 days of a loss sale disallows the tax deduction. Spread your tranches thoughtfully, or use an ETF like SPY or QQQ that's easier to manage tax-wise. Tranches, not lumps. This is how institutions buy. Step 3. Have a dip rules sheet written before the market drops. This sounds simple, almost stupidly simple, but it is the most powerful step on this list. Right now, while the S&P 500 is up, while your portfolio is green, while you feel calm, write down 3 numbers on a sticky note or in a notes app. Number 1. What VIX level triggers your first buy? Suggested 28 to 30. Number 2. How many trading days will you spread your dip cash over? Suggested 10. And number 3, what is your maximum dip allocation as a percentage of your total portfolio? Suggested no more than 5% of your total investable assets. That's it, 3 numbers. Then, when the market drops and your amygdala starts screaming, "Buy now or you'll miss it," you don't have to think. You don't have to check Twitter. You just look at your sticky note and you execute. This is called pre-commitment. The military uses it. Surgeons use it. Professional poker players use it. When stress hits, your prefrontal cortex shuts down. The only thing that works is a simple, written rule. A reaction buys the first dip and runs out of cash. A plan buys the dip across time and volatility windows and captures the true bottom. Insight, the investing principle beneath the fix. Now let me zoom out, because if all you take from this video is watch the VIX and use tranches, you'll execute better, but you won't understand why this works so much better. Here's the deeper principle. The market does not reward urgency. The market rewards patience plus structure. Every time you feel that rush, that "I have to buy now," that's not intuition. That's your brain responding to social proof. You see others buying, you see headlines, you feel FOMO, but the FOMO tax is real. Why does patience win? Because the market's natural rhythm is not dip then recover. It's dip, dip again, fake recovery, dip one more time, then recover. The institutions have seen it 1,000 times. They wait for retail panic to exhaust itself, then they buy. Your advantage as a retail investor is not speed, it's not information, it's time horizon and mechanical discipline. You don't have to answer to a board, you don't have to meet quarterly returns. You can wait, you can schedule, you can buy in boring, tiny tranches over 2 weeks. That is your edge. And this principle applies to everything. Rebalancing your Roth IRA? Use tranches. Adding to your 401k? Use tranches. Even selling a winning position to lock in capital gains? Use tranches. Dollar cost averaging into volatility is one of the most robust findings in finance. It doesn't guarantee you buy the exact bottom, but it guarantees you never buy the exact top of a fake dip. And over 20 years, that avoidance of catastrophic timing errors adds up to hundreds of thousands of dollars. Takeaway: strong motivation plus call to action. Let me summarize in 60 seconds. Retail traders love buying the dip, but the data shows they buy too early. They buy the first drop, not the real bottom. They exhaust their cash. Then institutions buy lower. Retail holds the bags. The obstacle isn't greed, it's loss aversion disguised as confidence. Here's your fix. 1. Watch the VIX, not percentage drops. Start buying when it closes above 28 to 30. 2. Never deploy all your dip cash at once. Use 10-day tranches, equal amounts, no emotion. 3. Write your dip rules on a sticky note before the market drops. Pre-commit, then execute like a machine. The principle is simple. The market punishes urgency. It rewards patient, structured execution. Now here's my challenge. Right now, pause this video. Open your Notes app. Write down 3 numbers: your VIX trigger number, your tranche days, and your max dip percentage. Take a screenshot. Then come back to the comments and tell me, what's your VIX trigger number? I want to see 28. I want to see 30. I want to see 35 if you're aggressive, but I don't want to see blank stares. Because the next time the market drops, and it will drop, you're not going to panic. You're not going to buy the fake dip. You're going to look at your sticky note and you're going to trade like an institution. Stop buying the fake dip. Start buying the real one. See you in the comments.